you disregard requirement number here. Balik unit. 10-10. Okay. So for 10-10, we have this answers. Then for 10-11, 10-11, operating income for segments. The requirement, prepare a segmented income statement for last year, calculate the weighted average cost of capital, the EVA, and comment on the performance of each of the divisions. So in number 11, first we have to begin with, actually we got three requirements or four. We still have the number 4 requirement. Prepare a segmented income statement for last year. So we have now last year, we had sales, and then the cost of goods sold given, deduct selling and admin expenses. And we have the income tax as stated. The income tax rate is 40%. So for the restaurant and the specialty. Now for the total, we have the after-tax income of 804. Then in requirement number 2, calculate the weighted average cost of capital. So we have now the common stock with common stock as given a weight of 75%. For the common stock, the two sources of financing, bonds paying 5% interest, which account for 25% of the investment. So 25% coming from bonds and 75% coming from the common stock. So we now multiply this by the after-tax cost. If we have the after-tax cost of here 0.0304 bonds equal to 5%. As stated, the bonds pay interest at 5%. And you multiply it by 1 minus 40%. 40% is the tax rate. So you now get 0.03 for the bonds, and we have 0.090 for the stock. Has been in business for over 15 years and is considered a relatively stable stock despite its link to the cyclical construction industry. Settled stock is an opportunity cost of 5% over the 4% long-term government bond rate. Total capital employed is 5.04 million, 2.6 for the home division, 1.7 for restaurant, and the remainder for specialty division. Now, the after-tax cost, if you have the tax rate equal to 40%, so you now get the weighted cost and the weighted average cost of capital. So for number 3, calculate EVA for each division. So we now have the after tax income of 174, 330, and 300. Then we deduct the tax. The tax after tax income, and then we deduct 195. That's for uh, 475 times 2.6. 2.6 is the amount of investment in the home division. So we have 75, and then we have for the restaurant and for the specialty. So we now get the difference as economic value added. So the after-tax income, that's the actual income, and then we deduct the required rate of return. The required rate of return, which is 75 percent or 0.7075. So as stated that the income tax rate is 40%. Now, comment on the performance of each of the division to the extent that each of the division now has its own uh, income and as well as its own EVA already computed for its own EVA. So what are now your comments with regards to number 4? While EVA is positive for Senold Incorporated as a whole, now you have positive EVA. It's negative for the home division. It's 21,000. Therefore, even though the home division has positive net income, it needs to increase net income, reduce the capital use to generate positive economic value added. Now that's for number 11. Then we go to number 12, transfer pricing and idle capacity. For number 12, what is the minimum transfer price that the glassware division would be willing to accept and the maximum transfer price that the bottled water division would be willing to pay should an internal transfer take place? What would be the benefit or loss to the firm as a whole if the internal transfer takes place? So in requirement number 1 for 10-12, the maximum price is given at 2.95. The minimum price is given at, here we have 1.13. So the difference of 1.82. During the year, the glassware division expects 390 cases of this uh, bottle. The bottled water division announced to buy 100 cases on the outside market. Justin can avoid selling cost of 12 per case by selling internally in that she would split the savings by offering 0.06 discount. So in lieu of 1.25, the unit variable cost 1.25, and that she can avoid selling cost of 0.12. So the minimum price is 1.13. The difference is 1.82. The number of cases, 100,000. So the increased profit of 182,000. Since the glassware division has idle capacity, the minimum price is the variable cost of 1.25 less the avoidable selling cost of 0.12. Yes, the transfer should take place. Requirement 2. Suppose Justin knows that the glassware division has idle capacity. Do you think that he would agree to the transfer price of 2.89? Suppose the counters with an offer to pay 240. If you were Eileen, would you be interested in this price? Explain with supporting computations. Justin might negotiate for a lower price. Eileen would consider the 2.40 price as her income would increase by 127,000. That's 2.40 the offer price minus 1.30. So we are now trying to consider a higher price than the one given here. So in number two, we have would you be interested in this price? Yes, to the extent that negotiating for a new lower price would involve an added income. Number three, suppose that Mouton and Pierre's policy is that all internal transfers take place at full manufacturing cost. What would be the transfer price? And would the transfer take place? So in number 12, requirement number 3, full manufacturing cost is 1.83, that's 1.25, variable minus 12, avoidable, and then we add 0.70, 0.70. So 1.83 would be the transfer price. The transfer could take place since 183 is between the minimum and the maximum prices of the negotiating data. Next, we have problem 10-13, transfer pricing in section 482. The company is a division in the US that produces and sells furniture for discount furniture stores. One type of dining room set is made in the international division in China. Dining room sets are sold externally in the US for $450 each. It costs $17.50 per dining room set for shipping and $21 for import duties. When the dining room sets are sold externally, uh, Jokasi Furniture spends $34 each for commissions at an average of 1.85 per dining room set for advertising, which section 482 method should be used to calculate the allowable transfer price. And using the appropriate section 482, calculate the transfer price. So the comparable and controlled price method should be used because the market price exists. So in number two requirement, calculate the transfer price. It will be the market price. We add the shipping and duties, and we deduct the marketing cost. So we have a transfer price of 452.85. Next, we have number 15. Okay. Number 15 is still transfer pricing, and section number 482. Number 15. Okay, so we have now the resale price method should be used because market price does not exist and the stain will be resold and not used. So this resale price equal to the transfer price plus 35% of the transfer price. So we now have the transfer price taken at 24.30. That's for number 15. Then we move on to 19. Okay, for exercise number 19, related to stock options. 19, related to stock options. Okay? So, 19, uh, Format Incorporated has acquired two new companies, one in consumer products and the other in financial services. The top management believes that the executives of the two newly acquired companies can be most quickly assimilated into the parent company if they own shares of a Fermat stock. Accordingly, on April 1, Fermat approved a stock option plan whereby each of the four executives of the new companies would purchase up to 20,000 shares at 15. The option will expire in 5 years. If format rises to 26.50 per share ang iyang stock, what's the value of the option to each executive? So we now have the value of the option of 20,000 shares on December 1 would be 20,000, and we multiply it by 26.50, and the value of the 20,000 shares on April 1 was only at 15. So that gives us the value of the option equal to the difference. Then discuss some of the advantages and the advantages of this type of stocks. Advantages: ownership of stock may encourage the executives to a long-term perspective, and it may make them conscious of the overuse of perquisites. These advantages open executives exercise the stock options and immediately sell the stock. In this case, executives are not owners of the firms and have no more incentive to act like owners than they did before the options. Okay, so those are the answers to number 19. The rest are similar problems than what we have already taken up. We have problem 6-27. This will be the last problem. 6-27. 27 involves bonuses and stock options. Lawana Davis graduated from State U with a major in accounting 5 years ago. She obtained a position with a well-known professional services firm upon graduation and has become one of their outstanding performers. In the course of her work, she has developed numerous contacts with business firms in the area. One of them, Shasta Incorporated, recently offered her a position as head of their financial services division. The offer includes a salary of 50,000 per year, annual bonus of 1% of divisional operating income, and the stock option for 10% share, 10,000 shares of Shasta stock to be exercised at 15 percent per share, $15 per share in 2 years. Last year, the financial services division earned 1,110,000. This year, it's budgeted to earn 1,600,000. Fiesta's stock has increased in value. Okay, so what are now the requirements? Advise Lawana, no? Advise Lawana on the relative merits of the Shasta offer. If Lawana accepts the new position, she'll earn salary of 50,000 and bonus of 16,000 in year 1. After 2 years, if Shesta's stock rises at the same rate as it has over the 5 years, she'll be able to exercise her stock option and realize gain on the following: price of the stock in 2 years, 15 times 1.16 times 1.16 times 10,000. Now we have gain of, okay. So we have now the price of the stock in 2 years. You multiply by 1.16. 201,840, and the price of the stock is 150,000. So you have a gain. Lawana will clearly be better off financially right away. Her salary plus bonus, which has ties $1,000 higher than her current salary. In addition, if the increase in net income for the financial services division, okay, can be sustained. She stands to make considerably more through bonuses in the coming years. The stock option exercisable in 2 years also gives Lawana the potential to make another 51,840. On the downside, Lawana's currently salary is attainable. Okay, so attainable for that purpose. And the increase in net income can be sustained. She stands to make considerably more through bonuses in the coming years. The stock option exercisable in 2 years also gives Lawana the potential to make another uh, 51,840. On the other side, Lawana's current salary is secured. The Shasta position has a lower guaranteed salary and the risk of bonuses and option values which may not be realized. If the financial services industry experiences a downturn, Lawana will suffer no matter how well she personally performs. Okay, so we have now problem 10-27 concluded. The final decision rests on Lawana's assessment of the risk versus reward of the two positions. She should also consider the risk of remaining in her present position. That is, what are her prospects for making partner at the professional services firm? Okay, that ends my lecture. So, thank you. Convert na mi. By the way, sige pa, kasumpa. As we did in the past, that will be at 6:15 in the evening, up to 8 o'clock. Anyway, I'll make an announcement again on Friday. Please don't forget the YouTube.